Welcome, everybody. Welcome to the Texas REIAs. The Texas REIAs is the largest by far network of real estate investor associations across the great state of Texas. About 150,000 members, participants, and attendees all the way back since 2003. And they say if you have the slightest interest in real estate, the very first thing to do is to go join your local real estate investor association, because that's how you can get plugged in to what's going on in the marketplace. So we're going to be talking a lot about what's going on in the marketplace. And we do a lot of things for Texas real estate investors. The Texas REIAs is the only active legislative group that protects the rights of real estate investors. We provide training, power teams. Some of you were clicking on the screens earlier. We have all kinds of resources from contractors to lenders to self-directed IRAs, tools, training, and tribe. And we provide market data to Texas real estate investors. And we're going to actually start today's presentation with exactly that, a market update, and talk about what's going on in the real estate market. So, what's the big news from real estate over the last couple of years? What's changed? What's the biggest thing that's happened over the last couple of years when it comes to real estate investing? Interest rates changed. Got it. Okay. So what happened to interest rates? What happened to them? They went up. Okay, they changed. They went up. So now they're different than they were before. So let's do a little poll of the audience. I'm going to give you two options. I would like everybody to vote. There's no right or wrong answer, so you can't get an opinion wrong, okay? So I'm going to say, do you think interest rates are high? Do you think interest rates are low? Okay, so let's do a poll of the audience. Who thinks interest rates are high? Raise your hand if you think interest rates are high. Okay, you're going to have to vote on one or the other, okay? So who thinks interest rates are low? Who thinks interest rates are low? Okay. Well, we got some lows over here. Everybody over here is high, so interesting. Not sure what happened with that. Okay, so my opinion is that interest rates are normal, okay? And that's just my opinion. I have been investing personally in real estate since 2003. I own about $30 million worth of rental properties, mostly rental properties, houses here in Texas. And most of my portfolio has a mortgage on it of somewhere between 6.5% to 7.5%, which, by the way, is normal by all historical standards. Now, a couple of years ago, interest rates got down to 3%. Okay, they got down to 3%. Now, before that, when was the prior time that interest rates got down to 3%? Anybody know? That would be never. It never happened before in your lifetime, in your parents' lifetime, in your grandparents' lifetime, in your great-great-great-grandparents' lifetime. When do you think it's going to happen again? Never. My guess is never. In your lifetime, your kid's lifetime, your great-great-grandkids' lifetime. I don't know. We don't know. Nobody knows the future. You know, but the world that would have to happen to cause interest rates to go back to 3%, you'll probably be more concerned about getting bullets for your AK-47 to fire at the zombies than you will about interest rates. But we don't know. Nobody knows exactly what's going to happen with interest rates. But they certainly changed. And if you've only been paying attention for the last couple of years, you're probably thinking, oh, they're high. If you've been paying attention for a long time, you'd think they're normal. Well, just to give you another data point, this is interest rates versus median home prices going all the way back to 1970. From 1970 to 1981, interest rates on mortgages got all the way up to, there it is, 18%. So for everybody belly aching about 7%, how about 18%? Yeah. So yeah, I would call this normal. Now, when interest rates go up, let's do a little vote of the audience, right? There's no right or wrong answer. So we're just asking opinions here. I'd like everybody's vote. I'm going to give you two options. When interest rates go up, what happens to home prices? Who thinks when interest rates go up, home prices go down? Who thinks when interest rates go up, home prices go down? Okay, who thinks when interest rates go up, home prices go up? Look at that. So a little of each. You know, I would say, my opinion is they go up and down. You see, here's what we've learned about real estate. Real estate doesn't really care about interest rates. Real estate doesn't really care about the economy. Real estate cares about two things, supply and demand, supply and demand. Only in as much as interest rates or the economy or anything else affects supply and demand does it affect real estate. Now, certainly, when interest rates go higher, mortgages are more expensive, so fewer people can afford a mortgage. That's true. So we have less demand, and reduced demand does push prices down, no question about it. But some other interesting things have happened at the same time. What else? We have a supply issue, okay? It used to be that historically, 2/3 of the house that you see for sale are resale, and 1/3 are new construction. That's the historic mix. Right now it's inverted. Right now it's 2/3 new construction, only 1/3 resale. Nobody's selling their house. Why not? Because they got one of those 3% mortgages and they don't want to give it up. So all that supply is being held off the market. Okay, so yes, we have less demand, but we also have less supply. And when you have less supply, that pushes prices up. Something else is interesting happened. 2002, 3, 4, 5, 6, 7, the banks came up with this idea called subprime lending. Remember that? You didn't have to have a job, income, or credit to get a loan. If you wanted a loan before 2008, you walked into a bank, you said, I want a loan. A banker would walk up, they'd hold a mirror under your nose. If they saw fog, you got a loan. That was the loan application process. And then in 2008, all the banks went bankrupt. Well, they were too big to fail, so we bailed them out. But they went bankrupt. But eventually, the banks got back into the lending business. And even when interest rates went down, lending got cheap, but it never got easy. It never got easy. Today, all these years later, what do you have to do to get a loan? Fill in a 1,900-page application, turn over your firstborn, submit blood samples, a lot. You have to do a lot. In fact, there's 82.5 million Americans that don't qualify for a mortgage, right? In fact, money is so hard to come by at any interest rate that the building slowed down. You know, and we're not building enough houses, right? And I don't know if you know this or not, but on a national basis, we're actually in the middle of a housing shortage. Who's heard of that? We're in a housing shortage. Yeah, we have 6 million fewer houses, okay, than we have people that need a place to live, right? And that shortage of supply is also pushing prices up. That's another thing that's pushing prices up. 2002, 3, 4, 5, 6, 7, anybody could get a loan. Builders were building houses out over the horizon in every direction. They built bazillions of houses. And then in 2008, the banks went bankrupt. Lending came to a stop. It didn't slow down. It was like a train that hit a wall. It stopped. And then we had all this supply and no more demand, right? And what happened in the market? Crashed, okay? And then after that, lending didn't get easy, so we have barely, if even, keeping up with the demand, and now we're not caught up with the demand. So it's a completely different market. Something else happened with interest rates. Why did we raise interest rates? To battle what? Inflation. Now, there's been a lot of talk about inflation. And usually when I hear people talking about inflation, it's like inflation bad inflation. We got to whip inflation. We got to beat inflation, get inflation under control. I disagree, okay? I actually love inflation. I really adore it. I have another name for it. You know what I call inflation? I call it appreciation. Yeah, same thing, folks. When the money becomes worth less, when you have inflation, where do you want your wealth? Yeah, in physical stuff, things like gold, things like real estate. How many of you have owned a house for the last 3 years? Raise your hand. Nice, you're a lot richer than you were 3 years ago. That's called inflation, appreciation. What if you had 20? What if you had 100 houses? Then how much richer would you be? Okay, you can't go back. You can do anything you want going forward, right? You can't go back, but you can do anything you want going forward. So yeah, we have a shortage of houses, of supply. We're raising interest rates to battle appreciation, okay? And people are not reselling their houses. So if you actually go back and you look at the chart, From 1970 to 1981, interest rates got all the way up to 18%. You know what happened to home prices? They actually went up. And when interest rates came down, you know what happened to median home prices? They actually went up. And when interest rates went up and down, up and down, up and down, home prices still went up. Now, we have some bubbles. There's that 2008, 9, 10 bubble. We had some bubbles for sure, but it's not as simple as like interest rates go up and home prices go down, right? There's not a simple correlation. So we have things that are affecting our supply and demand, and those things are pushing prices up and they're pushing prices down at the same time. And if you look at where we are right now, go forward to where we are right now, prices are flat. Prices are flat. And there's a reason for it. And we're going to dig in a little more detail. So Texas, this is Texas, the average price house in Texas, $433,000, up 1.5% year over year, flat basically. Median price in Texas, $345,000, flat year over year. Months of inventory, let's talk about months of inventory. Now, in my opinion, this is like the most important number on the screen. What is months of inventory? If you took all the houses that are for sale in the MLS and you stopped adding any more houses for sale, no more houses are going to get sold, we're going to just sell what we got, how long would it last? How long before they're all sold? The answer is 4.7 months, which is also the average amount of time it takes to sell a house. Some more, some less, that's the average. So let's put that in perspective. They say if there's less than 6 months of inventory, you have a seller's market. If there's more than 6 months of inventory, you have a buyer's market. If there's right around 6 months of inventory, you have a neutral market. Well, we actually have a seller's market, contrary to what some people realize, right? We actually have a decent market for sellers. Now, not as strong as it was a year ago. A year ago, we had 3.3 months of inventory, so we had a strong seller's market. Now we have a weak seller's market, but it's still a seller's market. And by the way, when I give you all this data, I do want to put a little disclaimer out there. Most of this data was pulled from the Texas A&M School of Real Estate and a number of other online resources. We do post all of this to our social media. You're welcome to download it. And I do want to also say, I didn't come up with the data, I'm just reporting the data, but we don't have an agenda here to try to persuade you of a specific opinion. We're not here to sell you anything or trying to convince you the market's going up, down, or sideways. We've been providing market data to this community for 20 years. When it's going up, we say we think it's going up. When it's going down, we say we think it's going down. Okay, we have strategies to make money in up markets and down markets and sideways markets. There are certain groups out there that always tell you the market's going up, whether it's really going up or not, right? And you know, I'm just saying this is the data, and I'm going to report the data. So historic data, 2021, prices in Texas went up 18% in 1 year. Great year. 2022 went up another 10.7% in 1 year. 2023 flattened out. So it went way up, went up some more, and then it flattened out. Now the sales are down, the volume's down. Less buyers, less sellers. If there were less buyers but more sellers, then prices would go down. If there were less sellers and more buyers, prices would go up. So we lost buyers and we lost sellers. So the volume is lower, and that's why the prices are flat. Diving into some of the different cities, Houston. Let's talk about Houston. The average price house in Houston, $445,000, up 4.7%. Houston's doing pretty well. The median price in Houston is $350,000, up 3%. Months of inventory, 4.3 months of inventory, a little better than Texas. Closed sales are actually up a little bit, basically flat. Lease prices are even up, 3.8%. When leases are up, and this is multifamily, like apartment buildings. We do commercial, we do residential. When lease prices are up, what does that mean? Does that mean apartment buildings are full or they're empty? It means they're full, right? When they're empty, prices go down, right? When they're full, prices go up. Listings are up, some new inventory coming online. Going back 3 years, 2021, Houston went up 16% in 1 year. 2022, up another 10% in 1 year. 2023, flat, just like Texas. Dallas, let's talk about the big D, Dallas. Average price house in Dallas, $525,000, up 2%. Median is 410, down 1%, basically flat. Closed sales volume is up a little bit. 3.9 months of inventory. I think that's the strongest market in Texas. Not as strong as it was a year ago. A year ago it was on fire, 2.5 months of inventory. It's still a pretty good market. 2021, Dallas went up 20% in 1 year. 2022, up another 15% in 1 year. 2023, flat. Well, up 1%, which is flat. Now, I don't know why this is, but we've always seen this. For 20 years, Dallas, for some reason, has always been the bellwether of Texas. I don't know why. If you kind of want to know where things are going, take a look at Dallas first. It's always the first mover. I have no idea why, but it's an interesting, data point. And there are certain things we look at. Inventory is a leading indicator. Sales volume is a leading indicator. Dallas is a leading indicator. Condos is a leading indicator. We call condominiums the canary in the coal mine. First thing to go up, first thing to go down, last thing to go up. Right? We call condos the canary in the coal mine. If the condo market is hot, everything's hot. Right? And that's just condos. So you look at condo inventory, it gives you a little idea what housing inventory is going to do next. Lease prices flat. Austin. Let's talk about Austin. Austin's an outlier. Something very unique happened in Austin. Let's talk about Austin. The average price house in Austin, $574,000 for the average house in Austin, Texas. That's not a typo. We did a little research to figure this out. We actually determined from some research the name Austin actually is Latin for San Francisco. Yeah. Elon Musk moved to Austin, and then Meta, and then Apple, and then Amazon, and then all these other high-tech companies and AI companies and semiconductor companies, and they all brought in these six-figure engineers, and everything went crazy in Austin, Texas. Median price, $450,000. Down. Average price and median price down a little bit, 3.4 and 2%. Months of inventory, 4.8 months of inventory. It's, I think, one of the slowest marks. No, San Antonio's a little slower, but it's still a decent market. But here's the outlier. Something very unique happened in Austin, Texas, and that unique thing is 2021. In 2021 in Austin, Texas, prices went up 29% in 1 year. That's where I own most of my properties. That was a good year. Yeah. But in 2021, here's what was unusual, something never happened before. In 2021 in Austin, Texas, there was 0.4 months of inventory, less than 2 weeks of inventory. It was normal in that abnormal time that somebody put a house on the market, they'd get 11 offers in a weekend. 1 would win, 10 would lose. So the 10 people that lost would put an offer on a second house that got 11 offers in a weekend. 1 would win and 10 would lose. And this would happen over and over again. And people got so mad, they started screaming at their realtors, what do you got to do to buy a house? I need a house. You keep giving me bad advice. I keep getting outbid. And in that very abnormal year of 2021 in Austin, Texas, in that abnormal year, it became normal for people to buy houses 5 to 10% above appraised value. Do you know your lender will not allow you to buy a house above appraised value? The total down payment and the total loan cannot exceed by $1 the appraised value of the house. If you want to buy a house above appraised value, you got to put the down payment, you got to get the loan, and then you got to bring extra money to pile on top of that after all that. And in 2021, that abnormal year, it became normal to buy houses 5 to 10% above appraised value. 2022, it went up another 10%, and then 2023 went down 8%. So in most of Texas, it went up 30% and flattened out. In Austin, it went up 40%, came down 10, and flattened out. What's the difference? Well, I guess it just doesn't matter depending on when you bought a house. You bought a house 3 years ago, you made 30%. Congratulations, no matter where you bought it. If you bought a house 1 year ago in Austin, you lost 10%. And that's just perspective. But that was the unusual year of 2021 in Austin, Texas. These prices down a little bit. And then finally we have San Antonio. San Antonio is the most affordable major city in Texas. Average price, $376, down 2%. Median price, $320, flat. Months of inventory, 5.3 months of inventory. It's kind of the slowest month, not bad. 2021 prices went up 16%, 2022 up another 12%, 2023 down 2%, basically flat. So that is San Antonio. So the question is, where are we going from here? Where is the market going from here? Well, I'm going to show you several market drivers, things pushing the market up and things pushing the market down. First, we have overall economy. Not bad. Now, real estate doesn't really care about the economy, but when the economy is doing well, people feel a little better or a little more likely to buy real estate. So it's a little push up. We also have consumer confidence. Consumer confidence is measured as people's opinion on a scale of 1 to 200. I don't know why it's 1 to 200, but anything over 100, people are confident. Anything under 100, people are scared. And right now, we're right in the middle, 102. They're a little confident, not really scared. That's not bad. And then we have the unemployment rate. Anything under 5% unemployment is considered solid economy, solid employment. We have less than 4% unemployment in Texas, so we have a great economy in Texas. Again, people don't really care about unemployment when it comes to real estate, other than if people have jobs, they're a little more likely to buy real estate. And then we have job growth. Oh man, we are creating a lot of jobs here in Texas. If people have jobs, they're a little more likely to buy real estate, so that's a little gentle push in the upward direction. And then, of course, we have stock market. Now, again, the stock market doesn't affect real estate, except that when people's 401ks go up, they feel wealthier. Last year was a great year for the stock market, so people feel wealthier. If they feel wealthier, they're a little more likely to buy real estate. And then next we have interest rates. Yep, interest rates went up. And when interest rates went up, houses became less affordable. So there's fewer people that can afford to buy a house, right? And more people are kind of waiting on the sidelines to buy a house. What else do we have? House price trajectory is flat, not really pushing up or down. It's flat. Closed sales trajectory down a little bit, but it's basically flat. What else? Pending sales trajectory, flat. Not much going on there, flat. Active listings, yeah, we're adding more listings, inventory, but we're just keeping up with the demand. And the demand is growing. Months of inventory, we're less than 6 months of inventory. Congratulations, you're in a seller's market. It's not as strong as it was a year ago, certainly, but it's still technically a seller's market. And then we have housing permits. Let's talk about housing permits. Yeah, we're building more houses. That's good, because we have growing population, so we're building more houses, but we're just really keeping up with the demand. And then we have migration. Now, this actually should be a triple-sized bullet. Not all these bullets are the same. This one should be like triple size, so I should have made it triple size. What is migration? Migration is the ratio of people moving in versus people moving out. Where's everybody moving? Texas, yeah. Last year, California lost 500,000 people. Last year, Texas gained 500,000 people. Where do you think they went? Pretty obvious, right? And then there's another 11 million people we don't know where they came from, and we don't know where they are, right? But I'll bet a bunch of them are here too. So the point is, the population is exploding in Texas, and that means more demand, because everybody's got to live somewhere. They either got to rent or they got to buy, but one or the other, they need to live somewhere. So we have a big migration. And then what? Construction labor growth. We got a problem. Contractors, general contractors, they're dying. The average general contractor is 59 years old, and the age keeps going up. So if you have a teenager Don't send them to college. Buy them a hammer, okay? Just give them a hammer. Make them I'm serious. Man, they'll make so much more money than a college grad. They'll be really happy. They won't have to work for some jerk that will have no student debt. I mean, it's like incredible what contractors are making, right? Great life, great money, right? Used to be like the college plan. No, the college people make less than the contractors, a lot less. And they work for jerks and they have a lot of debt. It's a totally different thing. So yeah, get your kid a hammer. I was reading this story about this surgeon, and his toilet backed up, so he had to hire a plumber to fix the toilet. And the plumber fixes the toilet, gives the surgeon a bill, and the surgeon almost has a heart attack. Oh my God, this is ridiculous. This is the kind of price a surgeon would charge. And the guy's like, yeah, I used to be a surgeon. Yeah. Contractors, I used to be able to build houses for like 100 a foot, 120 a foot, 150 a foot, 180 a foot. And then it was like 200 a foot, and then it was like 220 a foot. Now it's like $300 a foot to build a house. It costs a fortune. And it's labor. It's all labor. Well, it's materials too, but it's mostly labor. And then we got a couple of wild cards. You know, the economy, the election, inflation, and you know, interest rates. Where are they going from here? Now, here's the thing. The big bet is interest rates are about to go down. So that's kind of the last thing that's kind of pushing things up, and it's probably about to change, like in September. Nobody knows for sure, but that's where all the smart money is saying. So I don't know, that's the data. Let's do a little poll of the audience. Where do you think we're going from here? Who thinks prices are probably going to start going up? Who thinks prices are probably going to start going up? Who thinks prices are probably going to start going down? Okay, we got a mix, about 50-50. I'll give you our forecast. And we've been doing a forecast, by the way, for 20 years. So what is the forecast? The forecast is, that was it, folks. If you were looking for the market bottom, you probably saw it. There wasn't much to it. It basically bottomed out. And there's not much happening, right? The thing that's kind of holding people back is interest rates, and interest rates are expected to fall probably starting next month, and they're probably going to fall at least 0.5% by the end of the year. No guarantees, right? Things can always change. But when that happens, we should see a modest bump in sales volume, probably up by 2% for the first time in a couple of years, probably up sales this year, and we expect prices to be up 2 or 3% this year. So we don't expect much of anything. And there's just no big thing that would move the market a lot one way or the other. You know, shy of having a nuclear bomb that was unexpected fall out of the sky, there's just no big thing going on, right? Volume's probably going to go up a little, interest rates are probably going to go down a little, prices are probably going to go up a little, and probably not a whole lot is going to happen. That's our forecast. And I will say the Texas REIAs has been doing a forecast for 20 years, and almost every year it's been like spot on. And it's not because I would say we're geniuses, and I didn't come up with the forecast, I'm just repeating the forecast. But I would say the reason the forecast has always been pretty accurate is because it's not that complicated. Like predicting the economy, very complicated. Predicting the stock market, I'm absolutely certain it's not possible to predict the stock market, all speculation. But real estate, it's just supply and demand. And we know almost everything that you need to know. We know exactly how many houses we have. We know. We know exactly pretty much how many people we have. We know how many people are having babies. We know how many people are dying. We know how many people are moving here. We know how many houses we're building. We know how many we have. We know how many we're going to have. We even know how many houses we're going to need. We know almost everything, right? You know, we don't know exactly what's going to happen with interest rates and a bunch of other little details, but there's just not that many big variables that are not known. And that's why predicting real estate has historically not been that complicated compared to some other things. So was that helpful for you guys? Yeah. You know, we always encourage the group, the Texas REIAs members to be students of the market. It's a good idea to be students of the market. You know, you can make money in up markets, down markets, and sideways markets. Sometimes it's easy to buy, hard to sell. Sometimes it's easy to sell, hard to buy. It's never easy to buy and easy to sell. But I would describe the market we're in, I like this market. It's just normal. It's not abnormal. And I don't like abnormal. A few years ago, the market was on fire. It was impossible to find deals. Consequently, people were paying overpriced. They were paying too much for the properties. And yeah, it was super, super easy to sell, but impossible to buy. And I think a lot of people got hurt. Some people got lucky. A lot of people got lucky and didn't learn anything, so they did it wrong, but they still made money. And now they're paying the price because they didn't learn it right, and now they're doubling down on what is not the right way. I mean, it's just all kinds of weird things that happen in an abnormal market. Like I do commercial and I do residential. A few years ago, commercial, we do all kinds of commercial, including multifamily. And a few years ago, multifamily was very popular and it was very competitive. So people were paying top dollar to buy these apartment buildings. And the numbers worked because they got a 3% mortgage. And at 3% mortgage, they could afford, with the rent they collected from the apartment building, to pay the mortgage. But you know, the famous quote from Wayne Gretzky, I don't skate to where the puck is, I skate to where the puck is going. In commercial real estate, syndications, flips are 5 years, typically 5 years. You know, residential, the mortgages are 30 years. Commercial, the mortgages are 5 years, right? The lenders are small local lenders. They don't do 30-year mortgages. They do 5-year mortgages. Not all, but mostly. The investors, they put their money in. They want to get their money back in 5 years. People don't want to invest in something for 30 years. They want to invest in something for 5 years. So most of the deals are structured to turn over and over and over again every 5 years. The problem was, a few years ago, hyper-competitive 3% mortgages, people paying top dollar, and they made the numbers work because they got a 3% mortgage, but now they're selling them. And you can't get a 3% mortgage. So if they sell the apartment building for the exact same price they bought it for, right, the buyer doesn't get enough rent from the property to pay the mortgage at 7%, so the deals don't work, right? And that's caused a lot of disruption, okay? I was not very excited about commercial a few years ago. I remember getting pitched all these commercial deals, and I would always ask the sponsor, what are you going to do when interest rates get up to 15%? And a lot of the sponsors said, that's ridiculous. Interest rates will never get up to 15%. And I showed them the chart. Well, in 1981, they actually get up to 18%. So don't tell me they can't get up to 15%. Right? They can get up to 15%, and they did go up. And exactly what I thought would happen, happened to a lot of people that over-leveraged, right? Now, if you're buying commercial today, you have to ask yourself the question, in 5 years when you go to sell it, do you think interest rates will be somewhere around 7%? Maybe even a little better. I think that's a pretty good bet, right? When you're getting a mortgage that's never happened before in the history of the world, expecting to get that again, I don't think that's a reasonable assumption. When you're getting a normal mortgage, expecting to get it again, I do think that's a reasonable assumption, right? And that's why I like the market right now. Everything works in the market we're in right now, and things are very normal, and they're expected to stay normal for the time being. All right. If you'd like copies of our presentation, like I said, we do post these on our social media. I'll put some links up later on, and you're more than welcome to do that. And like I said, Texas REIAs provides all kinds of training, power team resources for its members.